Hello, everyone. We'll get started. This is Amber Walsh. I'm a partner in the McGuireWoods Healthcare Group. Our webinar today is Healthcare Acquisition Considerations in the COVID-19 era. And I am pleased to be presenting with several of my colleagues, all of whom spend a significant portion, if not all of their days doing healthcare transactions. The other presenters, in addition to myself on this webinar, are Gerald Thomas. He's a partner and chair of our Tax and Employee Benefits Group. Holly Buckley, a partner in our Healthcare Group. Rebecca Brophy, a partner in our Private Equity team. Tim Fry, an attorney in our Healthcare Group. And Kayla Marty, an attorney in our Healthcare Group. We will have today the opportunity to answer questions, hopefully at the end and throughout the presentation. So we would encourage you to take advantage of the Q&A button. And if we are unable to answer your questions during the presentation or at the end of the presentation due to time constraints, we are committed to following up with you to make sure that we can get your questions answered. So with that, I will go ahead and kick it off with some initial thoughts about transaction structuring and timing. So just a few words about the state of the transaction market in healthcare right now. Thus far, I frankly have not seen any deal statistics that I think give us a real picture of what is being closed, what is going under LOI. Right now, we are largely working on, of course, a few published deals, but a lot of anecdotal evidence, because what we have largely experienced on the McGuireWoods team is a pressing pause on transaction activity that occurred in mid-March. But with every week that goes by, more and more deals that were previously paused picking back up. Often they are picked back up on the same terms, but sometimes those terms are getting modified, and we're going to talk about the ways that some of those modified terms might be rolling out. We are certainly seeing every week more and more deal activity in the healthcare space. Deals are certainly getting done in a different way, and you are certainly having to engage in a lot of different techniques that previously weren't necessary. But we really view this as a natural extension of the way that deal making had modified over the past several years as it was. Already deals were more and more getting done on a remote basis, and this is an extension of that. We're going to talk today about several different elements of that. We're going to talk about transaction structuring and timing and some unique elements that buyers and sellers are facing. We're going to talk about tax considerations. We're going to talk about, when Tim presents, some of the unique diligence aspects that are coming out of this COVID-19 era. Kayla and Rebecca in particular are going to focus on some very specific deal terms that we are seeing emerge in order to basically balance risk and ensure that the deal can still get done. And then Holly will be concluding us by talking about closing and moving into the post-closing. Transaction structures, the theme that we're seeing a lot is risk mitigation where mitigation is possible. In other words, there are certain risks that simply cannot be mitigated right now, and for buyers and sellers that choose to go forward, some of what they are doing is focusing on risks that can be managed and taking risk in other areas where they have to take more risk than has historically been possible. It is a shifting in thinking on where you are going to take your risk. Because of this, buyers in many cases are preferring asset transactions in light of the potential unknown risks. Of course, as has always been the case, asset transactions may jeopardize several different elements of the ongoing operations. Asset transactions may result in more significant regulatory approvals, particularly in healthcare businesses that rely on certificate of need, licensure, Medicare certification, et cetera. And it can also be disturbing to the business to do an asset transaction. Another thing to consider is that an asset transaction may jeopardize the forgiveness for the PPP loans. These are some of the things that need to be balanced when considering if an asset transaction to better protect the buyer from risk is the right way to go for your transaction. Another thing that we are seeing is buyers and sellers alike are considering a bifurcated sign and close to allow for business rebounds. So, setting the terms of your deal at signing, but really making the condition for close largely based on coming out of the pre-COVID era in some predefined fashion that works for both sides of the deal. Another aspect that we are seeing in structuring is buyers and sellers exploring unique approaches to diligence, such as using more third parties to mitigate risk. So previously, if the buyer's team was able to do on-site diligence, more of their own internal financial forecasting, and a lot of other processes that may previously have been led by the buyer's own team, buyers are now turning to outside diligence third parties to assist with that. This is another way of shifting risk and ensuring that you are managing risk where you can. And then another way, of course, of risk mitigation is looking at rep and warranty insurance. And we are certainly seeing our colleagues in the rep and warranty insurance practice at McGuireWoods assure us, including our colleague Ann Dorsett, assures us that yes, absolutely, rep and warranty insurance is still being used. It is still used because it is a credit-worthy source of recovery. And right now, credit-worthy sources of recovery are particularly valuable. And for all the reasons that may have been looked at in the past, but anyone who is expecting to use an RWI policy should expect a broad COVID-19 carve-out. And then lastly, just a few additional thoughts on transaction structuring and timing. On pricing, buyers and sellers are considering unique ways to give credence to the seller's pre-COVID-19 operations, but with some risk mitigation techniques that are built in for the buyer. And as you can imagine, a lot of this turns on buyer-seller relative leverage. And right now, sellers are in a wide array of leverage positions, depending on whether they are in a distress situation and the extent to which their particular business has been impacted by COVID-19 and is expected to bounce back more quickly. But a few of the techniques that we've seen are basically blending pre-COVID-19 financial operations and current state, and still doing a paid upfront in full purchase price, but with a purchase price that's based on a blend. Another is to do purchase price holdbacks to be paid on achieving certain ramp back metrics. So in this regard, you can expect all manner of techniques to come up for consideration. We at McGuireWoods still feel like buyers and sellers need to continue to be careful about the regulatory implications of doing purchase price holdbacks and payments that approximate an earnout. So the same considerations that were present pre-COVID remain, but we are seeing a little bit more creative thinking in this regard. And there's a whole host of other options, such as traditional options, not buying the full business on day one, but having the buyer retain the option once certain elements of financial success are achieved. A last couple of thoughts before we turn on to the tax considerations. On the pricing point, consider the element of the pricing of the rollover equity. So as many of you know, in PPM and DPM transactions in dental and practice management, there is often an element whereby the seller receives a portion of the purchase price consideration in rollover equity in that go-forward MSO. That equity usually has always has a price attached to that, but quite often it's a price that has been in place for a while, and query whether that equity should be priced on purely pre-COVID financial performance of the MSO, or whether that should also factor in the insecurity of the business. And that's something that sellers will surely be raising to buyers, because just as sellers in those deals have to answer for the insecurity of their own businesses, they will surely ask buyer to do the same when pricing the rollover equity. And then lastly, on timing, transactions may be slower than typical. We are certainly seeing that due to the increased financial and diligence components and negotiation over a lot of these unique elements. Lenders may be getting more deeply involved in diligence than perhaps in pre-COVID times. And there's valuation processes that a lot of buyers are engaging in where they had previously relied on their own internal forecasting and valuation methodologies and are building in now third-party valuations, which can really provide a great source of comfort for the buyer and the seller alike, but also adds to transaction timing. So with that, I'm going to turn it over to Gerald to talk about some of the tax aspects of these transactions.
Thank you, Amber. So I think this is a nice segue. Amber has discussed looking at transactions from a legal perspective in light of COVID-19. So now let me address the tax considerations that we're all grappling with at this time. As a general matter, I would say that I'm not seeing any changes from a pure tax structuring perspective in the COVID-19 era. I believe it more so has to do with the benefits and other incentives that came out of the CARES Act that Congress passed in the last few months. But that's where the driver is. And I will first also say that is we're thinking about transactions in terms of asset transactions or equity transactions. Take the asset transactions first. Generally, in an asset transaction, I'm not seeing any impact arising from the CARES Act because the seller is simply selling its assets to the buyer. The seller's company remains intact. It may be wound down after selling those assets, or it may have other lines of businesses to continue to perform. But in general, the CARES Act is not really having an impact with respect to the transaction or the buyer. Now, Amber had mentioned something in her presentation in terms of there may be an impact on the PPP forgiveness or other criteria. And naturally, from a tax perspective, if that seller is also taking advantage of certain other tax incentives, which I will go into, there may be some things that the seller has to look at. But in general, I'm not seeing this being a driver. So the items that I've listed here on this slide really come into play when you have a sale of equity of a company. First, the payroll tax deferral. Just a brief background regarding this tax benefit. In general, employers and self-employed individuals are allowed to defer the employer's portion of Social Security taxes that are due from March 27th of this year through the end of the year. And that deferral of the payment, it will become due at the end of 2021, 50% at the end of 2021, and the remainder due at the end of 2022. This was one of the primary benefits that came out of the CARES Act. And the other primary benefit that came out of the CARES Act. The Employee Retention Credit, which is a new refundable credit that is allowable against the employer's portion of Social Security taxes, and it's generally equal to 50% of a certain wage base of each employee in a calendar quarter. And while I won't go into great detail, this credit, just generally speaking, employers are entitled to this credit if their business was fully or partially suspended by governmental order arising from COVID-19, or that employers' gross receipts are less than 50% of the gross receipts for the same calendar quarter in 2019. It just gives everyone a brief background of those benefits. So if you are a buyer in a transaction, one of the things that you also will be diligencing from a buyer's tax perspective and looking at what seller's operations are pre-closing would be whether or not they have taken advantage, the seller has taken advantage of these two tax incentives. First, the payroll tax. If the seller has deferred payment of payroll taxes to a future period, the buyer should be mindful of this, and that needs to be taken into account in the purchase price. Typically, we're seeing it in different ways, but you may see it as a component of indebtedness or just another downward adjustment to purchaser's price, because this liability is a pre-closing liability that has been shifted to a post-closing time in which the buyer would be responsible for paying these taxes. So obviously, a buyer would not want to bear the responsibility of that and would expect that amount to come out of seller's purchase price. Another item is, like as I mentioned, was the employee retention credit. This would be a pre-closing item, and it may be something that particular target could still take advantage of even after post-closing. So this would be something that a buyer would want to make sure it agrees with the seller's analysis in terms of being eligible for that particular credit, especially in these times because we don't have any formal guidance from Treasury on many aspects of the credit. We pretty much, taxpayers are having to rely on the website for the IRS, where they have a list of frequently asked questions and responses from the IRS, so that taxpayers have a brief glimpse into how the IRS is viewing certain issues. But that's not formal guidance to rely on a tax return, and we expect there will be regulations coming out to answer some questions that taxpayers have with respect to this credit. But at this point, certain taxpayers are just having to utilize their own analysis and reaching out to their advisors to answer these difficult questions. So that's why a buyer needs to make sure they analyze it and see whether or not they agree with that analysis or not, and then be able to make a decision in terms of risk allocation, in terms of that being indemnified for, if it rises to a level of an escrow and so forth. Granted, those are items that a buyer normally grapples with in terms of pre-closing tax items, but just again, in light of these recent incentives, it just adds on to what a buyer needs to consider in looking at these particular issues. Another item to mention that was in the CARES Act is the carryback of net operating losses of corporations. In recent tax legislation, with respect to NOLs, corporations were no longer entitled to carry back NOLs. They could only use them going forward. With the CARES Act relaxing that, or whether I should say allowing for certain NOLs to be carried back in 2020, going back several years to a period in which the taxpayer had taxable income and could offset that income with these NOLs and thus get a cash refund, is a great benefit to taxpayers in that it does free up some cash for them to be able to use. One area where I'm seeing this arise is in a purchase of a corporation scenario. Whereas without this benefit, sellers would try to get buyers to pay for their NOL, the use of those NOLs in a post-closing time period, or in some cases not being able to get paid for those, and that would just be a benefit that the buyer is able to utilize, subject to certain limitations under the code that restrict how much of the NOLs a taxpayer can use each year. But with this benefit now, I think it's important for sellers to be mindful of this in structuring in the contracts the ability to carry back those NOLs and receive the full benefit of those cash refunds. Because in some contexts, the buyer would have the ability to restrict the seller from carrying back those NOLs, and that is the buyer could just say to a seller, "You didn't negotiate for that in the agreement, so therefore I, buyer, now have the right to all these NOLs going forward because I, buyer, now own the corporation." So that's something to keep in mind, especially with advisors, using contracts from pre-CARES Act time period and maybe not taking into account these scenarios since they didn't exist at that time. So that's one, and I have seen that on a recent transaction where it's a very huge benefit to a seller to do so. The last item I'll mention, and it seems like a pretty mundane item to state here, would be looking at who's responsible for tax return preparation. Many parties, when they're looking at a transaction, again, we're speaking in terms of an equity transaction, generally speaking, may not see the importance of who's preparing the tax returns. It may be it's almost as if who drew the short straw and has to prepare the tax returns, unless there's certain items that they feel very strongly about. I believe in this era, it could be even more important in terms of allocating responsibility for the tax returns, especially when you're looking at pre-closing and post-closing. And we have a variety of types of entities, whether or not you have a flow-through entity or whether you have a C Corp. Well, I've mentioned one item with the NOLs where it was important to provide that the NOLs could be carried back to pre-closing tax periods, so the seller would make sure it gets done and could ensure that it receives the benefit of those cash refunds. That may also come into play. A seller may want to be able to make sure that certain positions that is taking with respect to pre-closing periods are being reflected on the returns and being more in the driver's seat of some of these items as it's structured as operations. It could be some things with respect to non-income tax returns, as I mentioned with the payroll tax deferrals and the employee retention credit, where certain analysis and thought processes were taken into account there. You may have buyers disagreeing with certain approaches and, yes, may have certain indemnification benefits that they're entitled to, but also may want to have first crack of how the return is going out there. And we may need to build in more items in terms of sellers and buyers working together to prepare these returns, having to go third-party accounting firms to regulate any disagreements between the sellers and buyers. These are just items that I think people should be mindful of and not gloss over, depending on the situation at hand. So I think with that in mind, again, the upshot is tax considerations are very much similar to what they were pre-COVID-19. It's just that with some of these items coming out of the CARES Act, it's important to take into account. And we'll see if there's further legislation that takes place over the next few months to address the economy, address taxes, and so forth that people should also be mindful of. With that in mind, let me turn this to my colleague to take over the next slide.
Thank you, Gerald. This is Rebecca Brophy. I'm in McGuireWoods Private Equity Group and work regularly with the healthcare team that's on the call on healthcare transactions. I'm going to be building upon a handful of concepts that both Amber and Gerald mentioned, and in a few cases in a bit more detail, really focused on the ways that we are seeing COVID-19 impact transactions, specifically around purchase price. And we're seeing that impact flow through all components of purchase price in some transactions, and really in all transactions, certain components. And that's focused on valuation, form of consideration, timing of payment, dealing with calculating working capital and setting up appropriate targets, and then other adjustments to purchase price like debt and cash. These changes are driving from several sources. Of course, just the overall economic uncertainty and operational uncertainty that many companies are dealing with, given the upheaval caused by government shutdowns and the pandemic generally. Then specifically as it relates to working capital, just significant difficulties right now in looking at the last couple months, or most likely upcoming months, in forming any sort of sense of what is normalized working capital or what is needed for a buyer to run the business going forward. And then also just the impact of certain companies participating in governmental relief programs and other operational relief actions that they've taken, and how that flows through to the various purchase price adjustments that we flow through in the purchase agreements as it relates, again, to working capital and debt and cash. So in terms of valuation, as Amber mentioned, we are seeing some instances where enterprise value is being reconsidered wholesale. That's certainly not universal, and what makes sense there is pretty specific to a target. As a seller, if you're involved in a sale process and you have not yet had these conversations with the buyer, coming up with a revenue plan going forward in terms of how you're going to be running the business or how you expect the business to be run while dealing with the crisis and considering potential shutdowns over the next year, would be a good way to get on top of those conversations. In general, in terms of when we read how valuation firms are looking at the COVID-19 impact on long-term valuation, there really has not been, from what we're seeing, a consistent view, other than in many instances we're not yet seeing a view that long-term valuation in certain industries, and specifically in healthcare, is going to be impacted by the COVID-19 pandemic. And certainly for the investors on this call that focus on the healthcare industry, which we suspect is all of you to some degree, thinking that we're seeing and our heads having McGuireWoods that healthcare is going to be one of the more resilient industries in terms of transactions going forward. So when we're talking about structuring the consideration and how buyers and sellers are bridging the gap with some of the current issues in the economy, we are seeing to some degree deals being re-looked at or retraded with some higher percentage of rollover in some instances. We also are seeing to some degree an increased utilization of seller notes to help buyers address liquidity issues and to push off some of the immediate valuation issues that buyers and sellers are facing. I think from our perspective, seller financing can be a great tool to help bridge liquidity gaps. It is something that as a seller, I think, has to be particularly focused on the terms of that note, whether they are unsecured and likely subordinated to existing debt, and how that might play into views of a buyer's credit risk. It is something to bear in mind. But again, we are seeing to some degree deals being restructured in terms of the form of consideration, or new LOIs being entered into with more significant seller financing concepts. As Amber mentioned Earnouts are another great way for sellers and buyers right now to be looking at bridging a gap between valuation. It can be the case that within certain of our clients on the phone or the folks on the phone, that's not going to be viable from a regulatory perspective. So that should always be an active conversation with your regulatory lawyers if that's being considered. But for folks within specific industries in healthcare where that is an option, it's a nice way to allow a transaction to close and allow both the seller and the buyer to share in potential enhanced revenue or other concepts going forward once the company moves out of the current crisis mode. So moving on more specifically to working capital considerations, and while working capital is certainly something that we expect third-party accounting firms and quality of earnings reports and business folks will be digging into deeply, this is also an area where we as lawyers get fairly involved in making sure the purchase agreement is appropriately drafted. And frankly, now and certainly prior to this crisis, working capital is the area where I think overall we see the biggest impact in terms of post-closing disputes and in terms of unintended economic consequences. So it's always an area where we're hyper-focused, and we expect business and accounting teams also to be hyper-focused. Since the COVID-19 pandemic and related shutdowns, we have seen significant grappling on the business end in terms of how to set appropriate targets with kind of the more standard trailing 12-month or trailing 6-month targets for normalized working capital being difficult to work with just because of the significant impact of COVID. Those can be very company specific in terms of what makes sense, but the one piece of advice we have is to get very early on in the deal process thinking about how working capital is going to be dealt with. Are you going to have a working capital target? Is there going to be some other, potential mini working capital targets that you deal with because the concept of normalized working capital doesn't make sense right now? So more than anything, I think getting ahead of that is what we're seeing people do, and just truly adding weeks into the timeline as they think through that. Some ways that we're seeing working capital be impacted in most companies right now are higher than normal AP, AR that might be lower than normal, or potentially not as collectible as normal, lower PTO than normal, potential issues with deferred compensation, and then certainly potential issues with less inventory or supplies. And the other key component of purchase price that we're seeing really impacted by COVID is the debt calculation. And certainly some of the current liabilities that I just mentioned in working capital are sometimes dealt with in debt. But there are some very specific measures that have been taken and government relief programs that have been utilized by many targets right now where the liability associated with that action is, at least on the buy side, almost always trying to be treated as debt or a debt-like item. And those are SBA PPP loans, and that might be an issue of some contention with the seller because they're forgivable, but we are seeing most buyers right now going out with trying to treat that as debt. Accelerated advanced Medicare payments, those look a bit more like deferred revenue, so they might be a debt-like item, they might be in working capital, but certainly something to have on the radar. And then deferred rent or compensation or any of the deferred taxes that Gerald just mentioned, as well as just generalized concern over potentially companies not spending as much as they should be on capital expenditures over the last couple of months. We are seeing an increase in capital expenditure concepts being treated as debt in terms of there being a cushion allowed for the buyer to have capital expenditures post-closing on the seller's dime. And so those big picture are some of the changes we're seeing in consideration, coupled with some of the concepts that Amber mentioned around timing as a result of the COVID crisis. Now, again, these are certainly items that overlap heavily with business and accounting diligence, in an area where we would expect to be collaborative with various members of the deal team, but very, very important areas where we do see big swings in just purchase price and take-home value for our clients. And these are also areas where we are seeing kind of out the gate immediate diligence questions from both the lawyers and the accountants to understand what government programs have been participated in, what actions have been taken that would have these impacts on purchase price. And so with that, I think I'm going to move over to my colleague, Tim Fry, who's going to talk about diligence considerations, including those as we look at the COVID impact.
Thanks, Rebecca. This is Tim Fry, and I'm going to assume those on the phone have already understand the importance of diligence, have either worked with our team or others, and seen how diligence can shape everything that has come before in these discussions. And I'm not going to try to spend any time convincing you that COVID-19 may change some of those questions or that it's important that you check those things for purchase price. I'm just going to assume you have that all in mind. And instead, with the next 3 slides, I'm going to try to give you a couple key places from our internal toolkits that we've been developing for upcoming transactions, where we're going to give you a couple places maybe where you can gut check, where maybe we'll have 30 new questions on a diligence request list. What are 3 or 4 that could give you a sense, is this a healthcare company that has been thoughtful as they've returned to operations in the COVID-19 era, or are they just kind of winging it, trying to treat it business as usual, and maybe you do need to get McGuireWoods involved with the 30 questions. So we're going to start with employees, because employees are, in most healthcare businesses, the most important asset. And employment then becomes so critical that we're following both employment law as it's evolved during this time, but also that we have a workforce that'll be excited about your acquisition, that will use this as an opportunity to talk about the future, and not a workforce that feels burned by the last 6 months or 3 months, and then you do your acquisition and they see it as a lost straw. So that's what we're going to kind of be thinking about with this slide. First thing I'll note as a question to ask is, what's been the return to work employment plan? OSHA has said that they expect employers to have a return to work plan. Needs to encourage social distancing. Think about masks and other PPE. Are you checking temperatures? What's the sanitation and disinfection protocols? What's the plan? If you do not have a plan, and in diligence there is not one produced, there could be significant OSHA workers' compensation liability coming. 2, for physician groups, PPM models. Many of our clients, many in the industry, I should say, have had to do draw reductions or draw adjustments for production-based compensation. How did you do it? What's the paperwork been like? How did the physicians feel about it? Did they willingly sign a letter so that they can't claim later that they don't have a non-compete challenge? Did they understand why you were shutting the offices down? Were they happy to shift to telehealth? What was the paperwork like? If there wasn't paperwork, something that goes to deal structure, maybe you do indemnity, maybe you put the physicians on new employment agreements, but you want to ask that question, you want to ask it early in the deal so you can figure out what other paperwork's going to be needed. Another employment-related questions, I just simply ask, how many of your staff members have taken advantage of COVID-related sick and family and medical leave? There may not be anyone that got COVID-19 and took the sick leave, but almost every one of your employees, I shouldn't say that, many of your employees were probably impacted by their children having school canceled. I know my household was. And the Families First Act gave leave opportunities for individuals that would be forgivable through the tax system if people were unable to work. And so they have to be given that leave. And if the answer is none of our employees took advantage of this leave, well, why not? Were you hiding this? Were you putting barriers up that broke the law? So those are just a couple employment questions that you could ask to kind of start to get a sense of what red flags there might be. Second, many of your acquisition targets will have taken advantage of the government programs that Gerald, Rebecca spoke about earlier. Not going to go through all of them, but since so many of them did, let's just talk about a couple so that you can start to get a sense of, were they thoughtful or did they just take the money and run? And that latter issue will be problematic as we fully expect the government to kind of sort of spend the next couple years chasing and auditing to make sure money was used to address COVID-19 related issues. So many of you on this call know in the Paycheck Protection Program, they sort of put the loans out and then changed the rules. Well, the SBA wasn't alone in that. The HHS Provider Relief Funding Program, the money hit people's bank accounts, then they released the terms and conditions, then they changed the terms and conditions, then they announced some of the limits on what you could spend money on, and then sort of said, oh, and we're doing a second round of funding, and that changes things as well. How have they thought about that? How are they using the money? How are they recording that? It's okay if they kept it and they kept the attestation, but the government has put these obligations on providers to use the money appropriately, and they will absolutely, we would expect, go after people in the future. And so you're going to want to be thoughtful and ask those questions. How did you think about it? How did you comply with the terms and conditions? If you had past add-on deals, did you keep that money, and how do you justify that? How are you keeping track of the tax deferral language that Gerald talked about? If you took advantage of the accelerated advance payments from CMS before they suspended the program, when did you get that money? When does your repayment program begin? Those are things they should know kind of at their fingertips. And if they do not have that at their fingertips, I think you're going to have to dig deeper, and we're going to have to ask more questions to understand, have they been thinking about these programs correctly? We're also going to dig further into vendor considerations. Many landlords in this country did not see May rent paid. There was a lot of deferral of rent. If your target deferred rent payments, what kind of documentation did they give? You know, I mentioned employees are often the top asset, but in retail healthcare businesses, often the leases are very high up there. You don't want to enter into a situation where you're asking for consent to do the transaction and the landlord uses that as an opportunity to come after you as the buyer, as the kind of money bank to, you know, pay off these past loans of kind of rent that has been deferred, unless there's a deal in the works. You know, does a relationship need to be rebuilt there? Technology vendors. A lot of healthcare companies have gone with non-HIPAA compliant telehealth solutions during COVID-19. They may not have gone through the bells and whistles of getting business associate agreements together, having the right type of healthcare telehealth platform in place. And there were waivers put in place during the public health emergencies that it was okay to do that. But pretty soon it's no longer going to be okay. What's their plan to transition? What kind of agreements do they have in place? Can they get better telehealth in place? And then I would also ask, what are their business continuity plans? What's their disaster recovery plans? Have they updated their emergency preparedness plans post-COVID? There's a really strong chance, if we listen to the scientists and the epidemiologists, that we'll have a second wave of this illness and virus. We may also have a second economic wave. All of those things they should have plans for and be able to answer. Here's our plan. Here's how we've thought about it. Here's how we've implemented it. And here's how we'd implement it differently in a new time. We can talk about other things like waivers if they have relationships, financial relationships with other providers, but I know there's still a couple more topics to get to as you think through a transaction. Diligence is just one part. Hopefully you hear from my voice how passionate I'm being. But I'm going to turn it over to Kayla. You do this investigation, you find some things that are wrong. How are the reps and warranties going to change? How is indemnity packages going to change in the COVID-19 era?
Thanks, Tim. This is Kayla Marty, and I'm just going to take a really quick amount of time to piggyback on Diligence, on the healthcare representations and various other representations that you should consider in your transactions as you continue to move forward. So as everyone on this webinar have already discussed, the CARES Act radically changed the way many healthcare businesses have been operating for the past 3 months. So it would be inadvisable for a buyer to move forward with a transaction without updating their reps and warranties to cover these new government programs that have stemmed from the CARES Act. So we would recommend, many of you likely on the phone have form agreements that you have used for years and have been updated over time. Now is the time to go back and update a few of these elements, either for a current transaction you have or for future transactions that you're looking at as we continue on through the year. But these are just a couple of things that we would really encourage you to include in those updates. So making sure that you have compliance reps that specifically touch on the CARES Act, and then also on the various governmental programs that you discover in Diligence. So the ones that we've listed here on the slide are just the most common programs that we've seen people participate in over the past 3 months, but there certainly could be others that have been, if you have a particular group that is in a subspecialty of healthcare that may have availability for funding in other areas. So you do need to look very closely at those during Diligence, like Tim mentioned, but here are just a few that we would recommend updating. And the key thing is making sure that not only the potential target is in compliance with the terms and conditions at the time that they take or funds from the government or participate in these programs, but they also are in compliance with the eligibility now to the extent that it has a forward-looking eligibility requirements, and then also the reporting obligations associated with these programs. As everybody on the phone has mentioned, we do expect that there will be audits, and they're likely will begin quite shortly. So if you have any potential target entities, if you're a buyer on the phone that is either going through one of those audits, you're going to want to dig into those really closely, potentially get additional representations on that, and then also be examining closely any repayment dates or any other important dates. Because at least, for example, for the HHS Provider Relief Funding Program, there are certain attestations or other requirements that run from the date that the funds were received. So making sure that you know what those dates are so you can be tracking ongoing obligations are very important, and we do recommend putting those in the representations. The next are employment representations. So Tim covered in great detail the particular importance of understanding what the potential business has done with respect to employment considerations. So before the CARES Act, I'm sure you're all aware, there was also the Family First Coronavirus Response Act, and that act changed a number of paid time off and other leave obligations on businesses across the country, which include some healthcare businesses. So you're going to need to be really aware of that. We do recommend considering compliance with that for purposes of representation. And then also obtaining any employees that are on furlough, reduced hours, or have deferred compensation, like Tim and Rebecca mentioned, and making sure that those not only get covered in diligence, but also make it actually into the terms of the agreement. So in the event there was someone left out in the future, or there's potential liability that arises in the future resulting from those individuals, you do have them covered through your indemnity and your representation that you're obtaining. And then on the seller side, for each of these items that we often see buyers asking for in this coronavirus era, we obviously want to make sure that we're mindful of that, keeping close track of this information as we go along. So if you do go through a transaction, you're able to fill this information out with respect to the representations and the disclosure schedules. So just like furloughed, reduced hours, or deferred compensation, you also may want to consider closely tracking paid time off and sick leave. That could be quite high for some businesses that have not been in full operations, whereas for hospitals, for example, people may be working overtime and not be having very many of these taken in the past 3 months. So every healthcare business may be a little bit different, but you just want to take a look at those. And also, we know that a number of people have been amending their employee benefit plans during the past 3-month period. And so there could be additional representations that are needed around those changes and making sure that those remain to be compliant. And then we listed here, just before Holly goes into the actual indemnification and post-closing period, some other key representations to consider. Gerald already covered the tax elements that you may consider, but we've just listed them here for completeness. And then also, as Rebecca mentioned, there may have been supplier delays on delivery of goods, or you could have deferred payment to suppliers. And so those may need to be covered in representations that you don't currently have. And also, many people have delayed capital expenditures. So buying those new pieces of equipment that you really need to operate the business, that often will be covered by existing representations that are in purchase agreements you all likely have or have worked with in the past, but you may just want to focus on those a little bit more than you may in some instances. So with that, I'll just hand it over to Holly, who's going to wrap us up and address some key indemnification and post-closing considerations.
Thanks, Kayla. So my first topic is, again, the indemnification package. And this kind of falls into 2 buckets. One is general treatment of the indemnification package, and the second is what I'll call COVID-related considerations. So as an initial matter, it's an appropriate time to stop and reflect on whether or not the leverage has changed from where it would have been pre-COVID. And this goes to things like escrows, caps, baskets, survival, and making sure that with respect to either the buyer or the seller's position, you're negotiating as best you can based on your current leverage. So it may be a good opportunity to say, we as the buyer may be in a better spot than we would have otherwise been. We're going to push for higher caps, lower baskets, longer survival, and really make sure we're getting the package that we want. After that, we need to look more specifically at how the indemnification package could or should change in light of COVID. So the first area would be escrows. It may well be appropriate at this point to get separate escrow for indemnification and net working capital. We heard extensively from Rebecca on net working capital and how impacted that'll have been from COVID, and so having a separate escrow there may be very appropriate. Also, it may be appropriate to have a separate escrow for things like the Paycheck Protection Program loan, the advance payments, or other specific issues that have been uncovered through the diligence exercise that Tim went through. So if there happens to have been a problem with how something was handled, it may be appropriate to have a specific escrow amount set aside for that, depending on the nature of the issue. With respect to indemnification, it may well similarly be appropriate to have specific indemnification for COVID-related programs. So and it could just be the fact that a seller has taken advantage of a program, and therefore you're going to have a specific indemnity to make sure that you have $1 coverage if something isn't right with that program, isn't right with how the seller has operated within the program, or it may be related to something you found in diligence in terms of whether, you know, the seller has properly engaged with its employees during this time. And then I'd say just one additional consideration would be with respect to specific caps on different types of representations. In general, in healthcare deals, we'll see some kind of heightened indemnification treatment for healthcare-related indemnification items. And so looking and making sure that that cap is appropriate, but then also looking at employment, where generally it's, unless there's a known issue, employment isn't treated as a heightened rep. But post-COVID, it may be that there's a lot more action on the employment front than we would otherwise have seen. So it may be worth having a specific heightened cap with respect to employment matters, or maybe just COVID-related employment matters. Looking at some other transaction considerations and risks, and we've kind of heard this from, I think, Kayla and Tim, in terms of third-party approvals. And landlords are a huge point here in that for those that engaged in rate abatement, it may well be that a landlord is not willing to grant consent to a transaction until this is all cleared up and the contracts are back in good standing. This may also be true for other payables such as EMR or other supply contracts that need to be fully resolved before the supplier or vendor will engage post-transaction. Similarly, with respect to government approvals, agencies may well be slow to respond. A lot of healthcare transactions require dealing with the Department of Health, and they're obviously the state departments of health are generally dealing with a pretty large load right now. And so in states that are hit the hardest, we can expect that there may be some delays in processing change of ownership and change of information forms, similarly with Medicare and Medicaid, although I haven't seen that yet. With respect to lenders, we can expect that there's probably going to be a slightly extended time frame for lenders to engage and finalize their reviews. I think that similar to buy-side counsel, there's going to be issues of first impression that come up where processing how a target and how a borrower has dealt with the various government relief programs and lending programs is going to take some time, and it's going to take some learning to make sure everyone gets comfortable. So allow extra time when bringing in a lender. And then where you've got a staggered sign and close, just given the fragility of the credit markets, it's important to have a really good financing out in your documents. Business risk, we've spoken to already, and kind of the risk of a business not performing as well post-transaction, given the lack of clarity on what the next 12 to 18 months are going to look like, as well as a lack of ability to appropriately value a company historically, given the last couple of months have not been indicative of maybe performance prior to that. So there's certainly business risk, and Amber and others spoke to different mechanisms to try and bridge that. We can expect to see a fair amount of differences in contracts as parties really try to avoid some of the hurdles they had to jump over in light of COVID. So force majeure clauses, clauses in employment agreements to try and give some flexibility if there's a cessation of operations and things like that. So there's going to be a fair amount of new things to digest. Finally, a few post-closing considerations. It's going to be really important to closely monitor the reporting requirements for government programs such as PPP, advance payments, and grant payments, and making sure that documentation is retained appropriately as the government comes out with its reporting requirements. There's also expected to be a significant amount of audits. We've already heard a lot from the government in terms of its intent with respect to auditing how funds were used from these programs. We've seen the DOJ already come out with its first indictment related to the PPP program. We know the terms and conditions for the Provider Relief Fund indicate that they'll be reporting and auditing following kind of those funds being used. So buyers and sellers should make sure they're keeping good records and are ready to engage with the government on that. On net working capital, again, as Rebecca discussed, important to prepare for the net working capital reconciliation early and prepare for net working capital shortfalls. And then hopefully no one has to deal with indemnification for issues that arise post-closing, but it's likely that that will happen. And as with all indemnification claims, there's balances there in terms of pursuing a claim versus having to deal with your long-term partners. So with that, we'll wrap up. We've really enjoyed the opportunity to engage with you again here today. We'll make sure to get back to you on your questions. There's not a lot of time here at the end since we've gone over by a couple of minutes, but we will try and follow up with those of you who submitted. And of course, you can reach out to any of us at any time, call or email, and we'd love to chat with you about any of these topics. Thank you so much.